Hello there. Lecture Series 22 of Bite-Sized Corporate Reporting focuses on IAS 19 Employee Benefits. This is a 4-part lecture series. The objective of IAS 19 is to prescribe the accounting and disclosure for employee benefits. IAS 19 requires 1. Recognition of a liability when an employee has provided service in exchange for employee benefits in the future. 2. Recognition of an expense when an entity consumes the economic benefit arising from the services provided by the employee in exchange for benefits. IAS 19 applies to employee benefits provided 1. Under formal plans or agreements between an entity and individual employees, group of employees, or their representatives. 2. Under legislative or through industry arrangements that requires entities to contribute to national, state, industry, or other multi-employer plans. 3. By informal practices that give rise to constructive obligation, meaning the entity has no realistic alternative but to pay employee benefits. Employee benefits within the scope of IAS 19 include short-term employee benefits, termination benefits, post-employment benefits, and other long-term employee benefits. Please be reminded, employee share-based payment schemes are not within the scope of IAS 19. These are within the scope of IFRS 2 share-based payment. Question: what is included under short-term employee benefits? This is employee benefits expected to be settled within 12 months of the end of a reporting period. It includes the following: wages, salaries, and social security contributions, compensated absences such as paid annual leave and paid sick leave, profit sharing and bonuses, and non-monetary benefits such as medical care, housing, cars, and free or subsidized goods or services to current employees. IAS 19 stipulates short-term benefits shall be recognized as follows: wages, salaries, and social security contribution shall be recognized as an expense based on the undiscounted amount expected to be paid in exchange for services as they are incurred on a normal accrual basis unless capitalization is permitted in accordance with another standard such as IAS 16, property, plant and equipment, and IAS 2, inventories. An entity shall recognize the expected cost of a profit sharing and bonus payments when and only when the entity has a present obligation, either legal or constructive, to make such payments as a result of past events and a reliable estimate of the obligation can be made. In the case of non-monetary benefits, costs recognized shall be based on the same principles as benefits payable in cash. That is, it should be measured at cost to employer of providing the benefit and recognized as it is earned. Finally, for compensated absences, this depends on whether the benefits are regarded as accumulating or non-accumulating. Accumulating benefits are earned over time and capable of being carried forward. In such situations, expense shall be recognized for future compensated absences over the period of services provided by the employee and typically results in a liability recognized at reporting date for benefits earned but not claimed. In the case of non-accumulating benefits, an expense shall only be recognized when the absence occurs. The second part of Lecture Series 22 will look at other employee benefits within the scope of IAS 19 employee benefits.